because a lot of these countries get into the EU, are the emerging markets rather, that borrow primarily in U.S. dollars or euro dollars, now are facing huge debts because their currencies have depreciated, but they have to pay their debts in the dollar. Never mind the currencies I just mentioned. So it's a serious problem, and it's destabilizing. And really, what we're seeing is in many ways, is a fracturing of fiat currencies.
Welcome to Wealthion. I'm Wealthion founder Adam Taggart. The US dollar has strengthened so much and so quickly this year that it's become a juggernaut, trampling pretty much every other asset. What repercussions is this creating, and how much longer is it likely to continue? For answers, we turn to market analyst Gordon Long, who just issued a report on this exact topic this morning. Gordon, thanks so much for joining us today.
Adam, thank you very much for having me. You know, it's amazing. Even last time, my timing was immaculate. We were talking about credit issues at that time, and you know, today currencies front and center, actually, around the world as we talk.
I know. I need to have you on more often, or maybe if it means trouble in the world, maybe I need to have you on less. I'm not entirely sure if we're the cause or the effect. But let me start with my usual very, very high level question, and then I want to get into some specific ones, especially about the dollar. But what's your assessment of today's global economy and financial markets?
I don't want to be negative, but we like everybody, there's some major concerns. But this time with the concerns that we've been facing for the last 20 years have been primarily US centric. You know, the great dot-com bubble, the great financial crisis of 2008. But this time, we have some very serious global issues, and it's showing itself, as you just said, in the dollar, but other currencies, whether we're talking the yuan, whether we're talking the euro, the yen, and as of this morning, the British pound, and they're reflective of problems in those regions and those kinds of those countries. That's not to say that we're home free in America, but right now we're seeing this massive flight, and have here for 6 months, flight to safety into the US dollars, and that's what it is. They're fleeing all of these currencies right now, and it's a good news, bad news. There are serious rollover issues with a rising dollar.
All right. Well, I want to get into those.
I can talk to the most. I'll jump right in. The most pressing one right now is, and I don't think people are paying real attention to it, is that the dollar's strength is driving up real rates, and real rates is measured, if you remember your Econ 101 of the Fisher's equation, and how central banks look at real rates. They don't look at a nominal rate and just subtract the CPI. They look at it from a real rate and inflation break-evens. And the point here is that 6 months ago, that real rate was negative 1.2. Today, that is trading at positive 1.4. And we've had in the last 3 months go from 0 to 1.4. And that is tracking to the dollar, but it's also tracking to the bond market. And the direct correlations in the bond market vis-a-vis the interest rates around the world. And these are having effectively destabilizing events right now, Adam, as it springboards, because a lot of these countries get into the EU, are the emerging markets rather, that borrow primarily in US dollars or euro dollars, now are facing huge debts because their currencies have depreciated, but they have to pay their debts in the dollar. Never mind the currencies I just mentioned. So it's a serious problem, and it's destabilizing. And really, what we're seeing is in many ways is a fracturing of fiat currencies. I don't want to go overboard on that, but we're creating this instability in it, and it's all a function of what we've done with quantitative easing over the last 10 years, and something Bernanke called enrich thy neighbor, with maintaining the fiat currency base, and it's starting to crack. That's what's happening right now.
Okay, this is a great conversation to have. It comes on the heels of recent discussions I've had with Brent Johnson, whom you may know, Gordon, but he put forth the dollar milkshake theory, which largely says, hey, for a lot of reasons, the dollar may strengthen he was saying this before this year, and for many of the reasons that you mentioned and that we're going to talk about here, and that can be very destabilizing. And you're saying, yeah, we're actually watching some of that destabilization play out right now.
Very
I
much
actually
so.
put out a tweet late last night, basically sort of comparing the dollar's strength right now to Godzilla, which is, every once in a blue moon, Godzilla would emerge from the sea and just destroy downtown Tokyo. And I sort of sarcastically said, well, today, the dollar is Godzilla, and basically every other currency and asset on the planet is Tokyo right now. This strengthening dollar is just taking everything down right now. Now, in the newsletter that you put out this morning, it sounds like you say that you see more of this pain continuing in the short term, meaning the dollar will continue to strengthen here. If that's true, let's talk about any more of the destabilization effects that worry you. But I also want to get into the fact that it sounds like you're on the watch for a reversal in the strength of the dollar here. It sounds like you think that it may actually start coming down at some point in the not too distant future. And I want to talk to you about that. You list like 4 reasons why you expect that. Maybe we can go into each one.
Yeah, we do. We think we're very approaching at least a temporary pivot here in the dollar and some strengthening. It's just a normal kind of rebounds that we see in currencies, and we'll retest following falling trend lines. But longer term, we think that the dollar, our opinion is that the dollar this year will reach its height, probably not too far off. But in 2023, the dollar will be a very weak currency. It will be a serious hit. So we've had strength this year, but we will have weakness next year. And a big part of this, and a lot of people are really misunderstanding the impact of inflation and really understanding inflation properly. And that is we're in what we refer to as the 5% inflation regime. And if you go back, Adam, and look at where we've had poor performance in what I'll call a balanced performance, 60-40, that is bonds and stocks, and you put them together, we've had 3 times where we've had very, very bad performance for 10 years. We had it in the second decade of the 19th century, of 20th century, 1910s. We had it in the 40s. We had it in the 70s. And those performances were just terrible. And the commonality was inflation was at 5% during those eras. Now, they may have fallen below it, but it was bouncing through it. And so we believe inflation will gradually move down, but 5%, that's the reality that we're in. And we've just went through a 10.5% decade of total performance in bonds and on equities, but that is a weakening kinds of issue. Now, what triggers that 5% inflation regime is inflation and valuations. So the first 3 that I mentioned, 2010, World War I, cost of the war, et cetera, 1940s, World War II, and it was a bunch of issues of production and everything else. It was inflating. And then in the 80s, or rather the 70s, which my gray hair tells you I was very active in that particular decade, which was brutal. It was an energy crisis and an energy shock that we went through. So in this decade that we're now facing, as we go into the next 10 years, we see that as a big problem, both the inflation rate and also valuations, the sustained high level of valuations that we have. They've come down, but nowhere near what they could be at. If you look at forward PE ratios as an indication of where earnings are going, and as you and I talked last time, earnings have been good. They haven't come down to match the forward PEs, but all the indications are that they're going to begin to slide pretty soon, and markets will react to that too, by the way.
Yeah, and I'll get to this later on, but it sounds like you're saying we should expect markets to continue their downward trajectory here for a bit as those forward earnings estimates get adjusted.
Exactly, but we're actually at a very important cusp as we talk right here today. because if you look at a lot of these trends that we're in, if you get into demographics and cycle turns, you can't trade a market with this. They're longer term, but they come into reality, call it the fourth turning in these issues. And we're in that period. And when you look at technical analysis for those that follow it and things like Elliott wave, there are certain fractals and mechanics that really allow those to come into being. And we actually have one in place right now that we've seen across market segments and really shows itself to us in the credit markets. And it's for those that are follow things such as the Elliott wave or familiar with it. Let me just call it, it's called a double combo zigzag. And we're at the middle of the corrective part of that. And we're testing it. And we think it will test it for a period of time here right now in what is called a continuation triangle. So we've had one strong leg down for the last 6 months. We will have this continuation triangle, which is, let me just leave it at that. I can show you a chart of it, Adam, that would really help it here. I'll send it to you. But then we'll have another trend down, another wave down, just as big as that first wave. And it's coming. So we've had a target, just to summarize here, of about 3270 on the S&P since this time last year is our target. We seem to be on track for it. And it isn't anything magical. It's just basic technical analysis.
Okay, so 32.
But it supports the theory because this double combo, if you study Elliott wave, it is something that marries up price and time where you need more time for sentiment to shift. And we have very negative sentiment, but it's an attitude. We still have a huge amount of beta traders and gamma traders that are trading at rallies, and that starts to fade. And we've had just a violent counter rally here in June that put a lot of people on the wrong side of the trade, and that will continue. That's not uncommon in this kind of market.
Right, and when you say this kind of market, I mean, is that sort of classic textbook bear market where
yes,
it's punctuated by these rallies that then suck everybody back in just to pull the rug back out from under them?
That's what we've got, and the textbooks written, and we've issued quite a number of charts showing the kinds of variations you get in these rebounds. But these have been aggressive, the counter rallies, and they will continue to be aggressive until it starts to wane. It's like a decay wave, a wolf wave, and just gets smaller and smaller, and then it breaks again. And,
okay.
For those that are technical analysis people.
And I've heard this from other seasoned capital managers of your generation, Gordon, and I'm curious if you think similarly, where they have said, by the end of a bear market, you were talking about sort of attitude. At the end of a bear market, all those beta and gamma traders you were just talking about, they're gone. Like nobody wants to touch stocks anymore. They've all capitulated. They've all given up. In fact, they say that kind of the last 25% of the bear market kind of happens right at the end when just sort of everybody capitulates. Do you see us as being on that type of trajectory?
That's exactly right. We have not seen a capitulation. We've seen some scares. Capitulation, Adam, and I've been there, is when you have to sell the stuff that you never thought you'd have to sell before to stay liquid yourself. And we have not occurred. And that is that second wave down. We've had the first, we're doing the consolidation, that's that next wave. That's when the capitulation happens. And this capitulation, and I hate to be negative, but I'm just trying to answer the question here. We have this massive ETF market, passive investing that we've put into place in the last decade. And it's never been tested. And so we have millions of people that could hit the sell button. And these ETFs are baskets of good that have to be liquidated. And right now they haven't hit the button. We have not seen that. But if that happens, and if you recall the 2008 financial crisis, what happened then was these chief financial officers, when we broke the buck in the federal, it was called the federal fund at the time. And when it broke the butt, all of the CFOs hit their button and started, because they were trading short-term securities, and it was $5 trillion. And Bernanke and Paulson headed up to the hill that day and said, if we don't do something, this market's gone. That was just CFOs. The ETF is a scary proposition for the amount of it globally.
So let me ask you about that, Gordon. So I've had folks on this program talk about exactly this. Bill Fleckenstein comes to mind, where he describes it as almost kind of this massive mindless robot that you have these ETFs that it's basically just a formula, right? Oh, we have to own these stocks in these ratios. And so money comes into the fund. Fund's got to go out in the market and buy those stocks according to the ratios that its algorithm tells it to buy, which is why so much money has gone into the big top 10 stocks, and why those are still largely propping up the indices. I mean, even though the indices are down 20+%, there's a lot of individual stocks that are down a lot more that just aren't in the top 10, right? And that has made things more challenging for investors this time around, because it tends to flood out sometimes the fundamentals of stocks. Maybe stocks are getting a lot of capital that don't deserve it, and stocks that do deserve capital aren't getting it just because of how those ETF equations are built. But the fear is that as that supports the indices on the way up, it could really pull them down if we get a big selling wave, if money's capital starts flowing out of these ETFs. Are you similarly concerned about that?
Very much so. Maybe I didn't articulate it properly, but that's precisely the issue. There's nothing wrong with ETFs. If you have them at the right time with the right market trends, they've been a beautiful performing set of assets, almost any ETFs. But they're based on, we've had this powerful move in technology, 5 specific stocks, we call them the FANGs, that have driven them and spill over into most of those indexes. There's no basis of valuation of individual stocks in those, typically in those ETFs. They're an index, they're a measurement, they're a basket that's put together, and they trade, and they can trade automatically, and they do trade basic on algorithms, and it works until something goes wrong in the fundamentals, or everybody starts to reverse their attitude or sentiment towards the risk associated with them. And when a lot of people that have said, I've got growth or I bought value, and they look at their monthly statement and they saw they're down 20-25%, they get nervous. And I know that in June I had many people asking me what to do because they were getting their statements and they were getting really nervous. Now, none of them sold. I don't give advice. I'm an investor, but none of them sold. That's what I observed. They said, "Oh, I'm going to hold in there." The damage hadn't happened, but when the damage does happen, that's the big concern in the market. I'm not saying it's going to happen, but that's the issue with the capitulation. But we will see capitulation, even if it's not driven by the ETFs, before this bottom is actually put in this market.
Okay, so we talked about the potential shoe to drop, probably the likely shoe to drop of continued profits compression, having to pull forward earnings down, which mathematically should bring down stock price valuations. We talked about how in a bear market, attitude shifts and people go from either buying or waiting to buy to starting to sell. And then we talked about how if capital starts flowing out of these ETFs, that could really exacerbate things to the downside. Does your 3270 price there for the S&P, is that a post-capitulation target?
Yeah, that's what we think it could go lower. There's a lot of people now starting to talk this lower, but that looks from a technical standpoint about right somewhere in there. If in fact it unfolds, don't ever count out the central banks globally to do something extraordinary. We saw that in 2008. We thought we could go a lot lower, and all of a sudden they changed the whole rules of mark to market, and the market just turned around on a dime. So you've got to be very careful. The central banks want to take down the asset values. They're taking it down now about 29, close to $30 trillion globally between bonds and equities since January. And they need to do that in a way of really fighting inflation. So, but they want to do it in a measured and a controlled fashion. They do not want panic. Just they want to lower it down, bring down that inflation level the best that they can do. Now, what I would say to investors out there, Adam, that are watching right now, the thing to watch for, and we watch it because we watch credit so closely, is, and we studied the second quarter earnings, and we're studying these ones, is when we went back and looked at inflation in this inflation regime eras of 5%, what we noticed was, and what is a consistent pattern, is when the earnings right now are going up. They're actually, some of them are flat, some of them are down, but earnings went up the last quarter. So, and even though the PE ratios, as I said earlier, have fallen dramatically. So what happens, surprisingly enough, at least historically, is that when earnings start to fall, the market actually bounces, because it's easy to price in inflation because you can plan it, you can work the algorithms. So the whole sentiment shifts, or the trading shift, is a little bit different when you're in this 5% regime of trading. So this is what could trigger a major counter rally at any given point. Never mind election results and other kinds of things. So it's a very nervous time. It's a very cautious time, and we're primarily ourselves trend followers. So we don't try and catch the top. We don't try and catch the bottom. We try and catch the trend and stay on the trend. And this trend has not firmed itself up for that next wave down. The long-term trend is very clear. And it ties into what we think will happen with standards of living, because of this shift we're moving from capitalism to creditism, and what that means with investing in productive assets, which I'll get into if you'd like. Okay.
I'd love to get into that a little bit if we've got time. So when you say the long-term trend is clear, that's down.
Yes.
But you're saying in the short term, too much potential that kind of anything could happen. And so you have to be very cautious.
As you always have to be. But this, we're set up. We've created quite a bit of damage here recently. So, and these counter rallies can be quite violent, as we said. So caution is always of the order.
Okay. I'm trying to limit the number of topics here because you keep bringing up so many great ones. You talked about the central banks and their level of influence here. But of course, right now, getting inflation under control is priority number 1, 2, and 3, it seems, which is amazing, just given how 6 months ago or so they were so dismissive of the inflation threat.
It was supposed to be transitionary, and
first it wasn't supposed to happen, and then it was going to be briefly transitory. But now they've got religion around it, or so they say. So where do I want to go with this? One, do you think they're doing the right thing here? I mean, it seems that they've said everyone's gonna take pain, right? We're gonna do whatever it takes to get inflation under control here. Some people are worried that the Fed is gonna break something systemic and create a bigger issue. Other people just want to go back to the wonderful salad days of the Fed, the Fed put and the Fed backstopping the market. Is the Fed doing the right thing here?
Well, it's not what the Fed says, it's what the Fed does.
Yep.
And we really haven't had, this is the first month where we've actually had quantitative tightening. We're only slightly bringing down the Fed balance sheet at this point in time.
Yeah.
So, but remember what the Fed's job is. The Fed's job is to make sure that the federal government can be financed, and that the debt itself, it can be managed and brought in. And right now, with interest rates, that 10-year bonds trading this morning at 3.8, we're at a level where, can we pay? What kind of hit is that going to mean to the budget? So there's this balance of fighting inflation, but also being able to maintain the actual budgets.
Right. And if I can just clarify for 1 sec, so you're talking about the cost of the debt service is going up as we jack rates up here too. One other knock-on effect is if they're causing a market correction, then there's less tax revenues to go in to be used towards debt service as well. So it's almost kind of a double whammy, correct?
Precisely. These are the issues that they're facing, and as they're fighting inflation. And once that genie's up, and this inflation war is going to be a long war. This is not something, it's going to come down. we're only at the beginning of the cycle. We will experience food issues. We have some scarcity issues. There are geopolitical issues. There's a whole sets of drivers, and we've noticed that inflation actually seems to come in 3 waves, and we've just finished the first wave, and we published newsletters on that. Whether that will happen again, but this is a tough battle, and really the Fed is looking at an L kind of approach. Bring inflation down, but then keep the rates high for a period of time. That's killing the budget. But if we do that, what's happening is we're going to kill the growth, and we're killing the growth, not the Fed, but the central banks together around the world. And the problem with that, Adam, is the debt. And everybody looks at the debt and says, well, it's $30 trillion in the United States. Well, it's not $30 trillion. We have 84 to 90 trillion of unfunded liabilities off balance sheet, Social Security, Medicare, benefits, etc. That's a debt that's now coming due as 10,000 baby boomers retire every single day. And so, as you just mentioned, there's tax money, there's income coming in from that's not happening, but is now going out, that we have to borrow. And we've got Russia just got rid of all their debt. China's not buying as much. We suspect the Japanese are selling bonds right now to help shore up the yen. That's our opinion. But with this real move to de-dollarization, as we weaponize the dollar, there's just a lot of pressure on trying to finance this debt to keep the rates low enough to bring in money to increase this amount of debt that we're going to have to increase. Again, this entitlement, but it's even worse than that. We have $212 trillion in something called a fiscal debt or fiscal gap. And what that is, Adam, is contingent liabilities. When we give foreign aid around the world, we don't actually lend them the money. We just guarantee their debt. So the banks lend them money, good rates. Bank says, why do we care? Charge them top bucks. If they default on it, U.S. government's good for it. Well, we're on the hook for contingent liabilities of $212 trillion. Now, why do I raise that? Well, with a slowing global economy, and you see what's going on in Sri Lanka, and you go around the world, these people that have borrowed a large amount of money, they've got some real problems on paying their current debt.
Yeah, those dominoes are toppling.
Did you see that? Sorry?
I said those dominoes are toppling.
Potentially. I'm not trying to, I'm just pointing the facts out here.
Well, some of them are. Sri Lanka's a great example. That one toppled.
This is frightening a lot of us that are in the credit business and saying, oh, just a minute. What is the risk here? What is the risk reward? And some of this stuff, and when it happens, nothing happens faster than credit, because liquidity disappears in a heartbeat, and it's actually starting to disappear. The banks are tightening very much so right now. And this leads into another point. It was a whole discussion itself. And because the banks are tightening, and we've got to push out money to fight this problem, we're going to see monetary policy giving a back seat to fiscal policy. We used to call it things like MMT or helicopter money, more of governments just literally pushing out money through transfer payments. And things like nationalization. We saw last week, France nationalized the uranium nuclear business. Germany nationalized Uniper, one of the biggest energy traders. We're seeing those kinds of movements, like we did when we nationalized, conservatorship with the Fannie Mae and Freddie Mac. So that's a way of pushing money out and keeping credit going, because we have a serious credit contraction. And the facts are, if credit doesn't grow at 2% a year on an annual basis and real basis, and it is not, we'll fall into a recession. That's another thing that people are missing. It's because credit isn't growing fast enough right now. And because we're tightening the heck out of it.
Well, Gordon, I thought you said you didn't want to sound pessimistic. But
there's never been a better time for investing, Adam. That's the irony of this. If you're on the right side of these trades, it's been a phenomenal time. It's been a good couple of years, and I think it'll be a good couple next couple of years too.
All right, well, let's go there. Let's talk about the opportunity side of this thing. Where do you see the biggest opportunity right now as you look out, in the horizon, amidst all of these swirling plates we've just talked about here? And maybe in your answer too, if you can kind of address sort of how one can perhaps position for the the decline in the U.S. dollar that you think is going to happen, the material decline in the U.S. dollar strength that you think is going to happen over the next year?
Yeah, they're kind of one and the same in the answer. We strongly believe that we're at the beginnings of a commodity super cycle, and that commodity, though they're down and they're correcting right now because of the strength of the dollar, but as the dollar weakens, those will change. So we think a portfolio broad-based of commodities, not necessarily industrial metals, but certainly priced in energy, certainly priced in food, soft commodities. These kinds of areas are things you need to really be looking at. We used to refer them as just simply hard assets. We think that there's a day of gold and silver, though that might mean we're getting down to production costs right now, just the cost to produce it. And nobody's going to produce gold if they're going to sell it for less than the cost. So I'm not saying to rush out and buy it today. I'm trying to say that these are the opportunities if you're a longer term. And as I said, we're trend followers. When the trend really starts to shape up for the next leg, we think they're in. And that'll be the place. That'll protect you from the dollar. It'll also put you into something that should be value, because a lot of these commodities have been poorly invested in for decades. We just haven't been putting the money in with financialization and where the cash has gone. And it's not like you turn a switch. It takes a long time to bring on a mine to start to produce any sort of commodities.
Can I just interrupt you to ask one question? So I've had natural resource investor Rick Rule on this program frequently. In fact, he just had him on this weekend.
Nobody understands it better than Rick.
Yeah. Okay. So, Rick had said before, I mean, he was saying this years ago. Hey, even if growth continues at the status quo, we are going to experience substantial shortfalls in key commodities because of the lack of investment in exploration and development and CapEx and infrastructure that we've made over the past, say, 2 decades or so. We just haven't been putting the investment in a lot of these sectors that they've needed. Now, of course, over the past year and a half, we've had the pandemic and the war in Ukraine that have just sort of, completely discombobulated global supply chains and trade relationships, which has really complicated that factor. Are we materially even worse off than we were before all this happened in the past 2 years? Like, did we just make a bad situation a lot worse?
We did, or we look at the flip of it, we've just created one heck of a great opportunity, because
for investors,
we have not invested. And even if we choose to invest right now, those supplies are not going to come to market
for years or
for a few years. And when there's a scarcity like that, prices go up. But there's something even as big as that is. There's something else more profound going on here right now. And that is the shift in the world from a unipolar to a multipolar society. And what I'm referring to is the power that China and Russia are now starting to exert on the world. And we have to remember there are 148 countries in the world that their primary economy is the export of commodities. They don't manufacture. They just export some form of raw commodities. And they've always been poor countries because commodities have been beat down. Well, if you look what's going on with Russia right now and China, with the formation of the Belt and Road Initiative, where they've brought them together, the Shanghai Accord, they have put these two groups, these players together, who all feel that they have a common interest as commodity suppliers to the rest of the world. And they're starting to exert their muscle right now. And they're starting to say, I'm not going to give my product away anymore. I can't afford to. And so and this is, well, you've just seen Russia use energy. You've just seen what they're doing with fertilizer. You'll see the same thing with China. So there's this big geopolitical threat. And at the industrial G7, who depend on, we add value, but we add them to commodities. And that's the threat that's now threatening the world, and it's destabilizing. And never forget, that you can't, wealth can only be created by growing it, mining it, or building it. You can't print it.
Right.
And so you can print all this paper, but that's exactly what it's worth, the value of the paper. And I'm not trying to be down on Fiat, but the Russian-China shift right now in power and the conflict is giving a lot of money, a lot of power to these commodity players. So I think that's one of the big themes that people are really underplaying right now.
Okay, and of course that's what sadly Europe is learning in
The
spades
hard
right
way.
now, which is, hey, no matter how much the ECB may want to print overnight, it's not going to create another barrel of oil or BTU of natural
I
gas.
got relatives in Europe right now that have wood stocks or forest lots, and they're worth more than gold right now,
Yeah.
preparing for the winter and selling them. This is in Austria.
So, right now, emerging markets are getting taken out to the woodshed by the rising dollar, right? Because we have a slowing global economy. So demand for natural resources is generally shrinking. Some energy supplies bucking that trend, obviously. And the debt of these countries is oftentimes dollar denominated, as you were saying earlier. So emerging markets are getting really squeezed right now. Given what you just said, I would assume you would think, hey, this starting to look like a good time to maybe start looking hard at these emerging markets. Maybe they're on sale right now. And as the super cycle kicks back up and the dollar starts coming back down, emerging markets investments could probably do quite well.
Yeah, we call it the echo boom, that would come back like a boomerang from the problems they've faced and the position that they're in, that the emerging markets have the opportunity. But it's a very dangerous market because it's so geopolitical and political centric. And it's not just the commodity, it's the country itself that you have to be very, very careful and do your homework. Just don't go out and buy a basket of ETFs. That's not the way I would recommend you looking at the emerging markets. But there's every chance that over the next and we take a longer view of things, 18 months, that there's going to be some very good returns made in an emerging market relative to the rate where we're going to be overall in the markets, because we think there's a beta drought, that this 5% inflation regime we talked about earlier over the last 10 years is what we'll see. So it's going to be the days of the stock picker we think are coming back.
Okay, that's where I was going to kind of go. Yeah,
that's where we're going. And nobody seems to want to invest in those people. We're not stock pickers to sell. We're stock pickers by design because we invest our own money, but that we see that coming back.
All right, and you are providing the best endorsement, if you will, of the financial advisors that Wealthion works with, because that's the cloth that they are cut from, and they have been very frustrated for the past bunch of years where we've really had to focus on Fed policy because that has been the primary determinant of the price action. And then we've had these robotic ETFs that we talked about earlier, which combined with the Fed, Fed always backstopping the market and capital coming into these ETFs, just all boats rose, right? Now we're entering a time period, if I'm decoding your words correctly, where the tide is going to be coming out to a certain extent investing wise, and to get a return to buck that trend, you're going to have to do your old school gumshoe research and find good sectors that have good prospects, and then pick out the diamonds in that sector, and you're really going to have to go back to active management.
But that's been the way it's been in markets for 100 years, except for the last 10 thereabouts, where all you had to do was look at the Fed's balance sheet and just that told you exactly what the returns were going to be every single month. It was as consistent for 5 years, and then marry it up with the amount of buybacks that were happening, $10 trillion worth of buybacks in the last 20 years, the amount of dividends that have been paid out by borrowed money on interest, and it's very easy to see what happened. They're coming to an end. That is stopping because we're moving from a trend of interest rates going down. We've hit the zero bound to a trend of rates going up. And we've already begun that reversal. And where rates they'll fluctuate, but the trend is now up. How long that trend is, that's another discussion.
All right, so we've had a multi-decadal decline in bond rates, interest rates.
40 years, since Volcker in 1980.
Okay, so since Volcker, And you believe we've now bounced with that trend has hit the floor and is now headed the other direction.
I do. We do.
Okay.
We do. And because the debt amount is so significant that it's forced it. There's a shortage of capital. Well, there's a shortage of collateral is the problem. And that gets into something called financial repression and how governments usually get rid of the debt. And that in itself is even changing. I mean, we'll probably have to leave that for another day, but
we will. The problem is the last time I had you on, we ended with a cliffhanger on financial repression. I told folks I'd have you back on and we dive deeply into it. We haven't had the chance yet, and given everything that was going on in the dollar, I wanted to have you here to talk about your recent report. Could you maybe just give a minute or two on just sort of the financial repression, what is it, and what the customary playbook is, and then I can have you back on in the future to really go into the details?
sure, Adam, absolutely. Financial repression is a macro-prudential strategy. It's not something negative. It's not meant to be a conspiracy. It's used by the central banks as a way of reducing the national burden of debt. And how they do it is through negative real rates. So they basically debase the amount of debt so that they're going to be paid back with smaller dollars. And it works very effectively. But it doesn't work, as I said earlier, when we've got positive rates. We've seen the rates go from negative 1.2 to positive 1.4 this morning. So how do they turn around and reverse it and take it all the way down, back down to negative 1.4? That has profound implications, because the Fisher's equation that I mentioned earlier, which is how they look at things, and this is, we look at real rates and we just say, what's the nominal rate of the bottom? What's CPI? We subtract it to and say it's negative. Well, no, that's not how they look at it. They look at what the break even of the 10-year, for example, is, and then they look at what the real rate is. The two of those equal the 10-year, and every night that closes within 0.01 of the number. So how do they take that down? Well, we don't think they can take that down. So the whole element of financial repression is changing, and how they're going to do it. And that involves things such as regulatory repression, that involves monetization that they've never done before. That involves quick debasements of the currency, which they've always used, but things like we potentially may see a Plaza Accord like we did in 1985, forced by these emerging markets that you just mentioned earlier, saying we got to fix the dollar because it's killing us. And changing. So these are the things that are central to repression, to do financial repression right now.
Okay, and I know you said it's not personal. In other words, it's not a conspiracy. It's not something that's totally like, behind closed doors or whatever. But it's where I'm going with this is it doesn't tend to work out very well for the average citizen in terms of their purchasing power and their attempts to preserve their wealth. Is that a correct statement?
Absolutely. What it means is a reduced standard of living.
Okay.
Effectively, that's what it means. We were going to see standards of living relatively falling, and that's what's going on. And they're forced, the last comment I make on it, they're forced to do it, Adam, because we've moved from capitalism to creditism, and that is capitalism is about savings. There's this thing called savings, and that savings is invested in productive assets. And those productive assets create productivity and the standard of living goes up. Today, we are in creditism where we don't have savings, we create credit, and that credit is then used for consumption, not investment. And therefore, the standard of living falls for it, especially if you consume more than you produce. So and as the bigger the debt, the more the lead, the more it takes, more of the debt is being used for consumption, and especially in a 70% consumption economy. This is the trap that the central banks, not just the Federal Reserve, but the central banks have got themselves locked into right now. And there's various solutions way out of it. The world's not coming to an end. It just means we're going through these various regime changes.
Right. But the important thing is it's important to understand kind of how this playbook operates, but also to understand what solutions that the central planners are choosing to deal with it, because that's going to influence what decisions you make to basically protect your wealth from the impact of the repression that they're engineering.
Get yourself a good financial advisor and really knows what's going on, and listen and get that advice. This is not a market just to speculate and throw darts. You really do need to do your homework. But there are some tremendous opportunities, because it's always easier to do something when you know with relative certainty what the powers to be have to do. And right now they're trapped by unsound money, global paralysis of policy, and the inability, well, a number of other reasons. That's
all right. Well, look, our financial advisors, like I said earlier, Gordon, they're going to have to send you a really nice big fruit basket or some kind of gift, because you've just made the best argument for why folks should consider talking to them at least. And folks, as I've said often on this channel, and as Gordon has said several times here, it's a really tricky, treacherous time right now for investors of all experience backgrounds, even big long-term professionals like Gordon. But for the average person, it can be a very overwhelming time and a very dangerous time, because it's a lot of dust in the air. You don't want to make the wrong decision just because you don't know what you're doing, which is why working under the partnership of a good professional financial advisor who understands these macro issues is so important right now. And if you've got a good one, great, stick with them. But if you don't, or if you'd like a second opinion from one who does, feel free to schedule a free consultation with the financial advisors that Wealthion endorses. Doesn't cost you anything to talk with them. There's no commitment to work with them. There are no strings attached. It's literally something they offer as a public service. They'll hear your personal financial situation. They'll tell you what they think you should do. You can implement it yourself. You can implement it with your existing advisor, or if you like these guys, you can talk to them further. But anyways, if you want to set up one of those free consultations, just go to Wealthion.com. It only takes you a couple seconds to set them up. Well, Gordon, look, thank you so much for sharing so much of your time and your expertise with us right now. We just finished a conference this past weekend, which could not have been more timely. It would have been wonderful to squeeze you into that faculty. We'll have to do it next time, Gordon. But folks, if you are interested in purchasing the replay videos to that conference, if you missed it but wished you had watched it, don't worry, you can watch all the replay videos of all the presentations, all the live Q&A. We captured everything. Just go to Wealthion.com/conference and you can purchase the replays there. And folks, if you've enjoyed this conversation with Gordon, you'd like to see him back on the channel and other great experts of his caliber, please do me a favor, support this channel by hitting the like button and then clicking on the red subscribe button below, as well as that little bell icon right next to it. Gordon, thanks so much for joining us. I hope we can have you back on in the near future to pick up this conversation, at the very least, just on financial repression alone.
Adam, thank you for having me. I always enjoy these conversations.
All right, always a pleasure. Thanks so much again for joining me, Gordon. Everybody else, thanks so much for watching.